What's happening, guys? Welcome back to Dynamo DeFi. My name is Patrick, and on this channel I talk about cryptocurrency, decentralized finance, and economics. So if you like those topics, be sure to like and subscribe. Today's video, I'm going to be taking a look at the Terra Luna ecosystem and how to yield farm on the Terra network. The Terra ecosystem is definitely one of my favorite ecosystems in DeFi right now, probably my favorite. And that's because whereas most ecosystems have their version of Uniswap, their version of Compound, etc., the dApps on Terra Luna are unique. And not only are they unique in the world of cryptocurrency, they actually provide a use case and solve problems that traditional finance does not. So they really unlock the power of DeFi and allow people who might not even have an interest in the technology to benefit from this technology. And as they say, with fundamental analysis comes alpha. So today I'll look at some ways that you can take advantage of this growing network and earn some incredible yields. Great, so let's jump right into it then. There's 4 main strategies that I'll be looking at today. Each of them has their own positives and negatives, and they each fits a different risk profile. First is to deposit UST on Anchor. So just taking some money that's in dollar stablecoins and earning yield on that. Second is to stake Luna through the native staking feature in Terra Station and earn airdrops and a proportion of Terra's network fees. Third is where we really start to get into the DeFi degen territory. That is, you provide your Luna as collateral on Anchor and then take that loan and reinvest it into a liquidity pool on Pylon protocol. And I'll go through the details of all this as well as what sorts of yields you could expect. And the fourth strategy is the same as the third, but instead of putting the borrowed money as well as the Anchor rewards, because Anchor actually pays you for taking out a loan, you take those and put them on Mirror protocol in a synthetic asset farm. And so this might give you exposure to tech stocks or the NASDAQ or even something like synthetic silver stock. And so if you're looking to get some exposure outside of cryptocurrency, maybe to something like Tesla stock, then 4 would be a good strategy for you. And I'll go through all of these in detail. Great. So there we go. Let's hop over to Brave and take a look at strategy number 1. So Anchor protocol allows you to deposit UST, and right now the APY on that is about 19.5%. We'll claim that later. So 19.5%, which is pretty incredible. I think you'd be hard-pressed to earn this on dollars really anywhere. I mean, imagine getting that from a bank. And remember, this is a dollar-pegged stablecoin, so this is not actually cryptocurrency, or this is a cryptocurrency, but not actually something that you would earn appreciation on. You're just earning the APY. But that's pretty incredible. I think maybe you could get that interest rate if you moved to some sort of sketchy area and started a loan shark operation. You could charge 20%, but that's a lot of work and it has its own risks, so we'll stick with Anchor. And the way they're able to guarantee this APY is, first, people can borrow money off of Anchor, and then they pay roughly 20% interest rate. But additionally, what Anchor does that's actually unique is when people provide cryptocurrency as collateral, so for example, Luna, soon they'll be able to provide Solana and Atom and DOT and others. Because those coins can be staked for rewards, while they're provided as collateral, Anchor actually stakes them and earns rewards, and so they build up a yield reserve that they can use to guarantee these high APYs over time, which is pretty ingenious if you ask me. So that's strategy number 1. Pros of this are maybe you have some profits you're taking from a coin that's up, or maybe you have some money on the sidelines that you're waiting to buy a dip with, rather than just keeping that money in your bank account and letting it get eaten away by inflation. You can actually put it in Anchor and earn these crazy APYs. So then when you're ready to buy in, you have the money there, but in the meantime, you're earning some nice interest on it. Negatives of this are, of course, that you don't actually get exposure to any crypto assets. So with this strategy, you wouldn't be exposed to Luna. You wouldn't be exposed to any of the protocols built on Luna. So that is strategy number 1. Moving over to strategy number 2. That would be to stake Luna for rewards. Yes, so in this one, we are going to jump over to the Terra Station wallet. And you can see this wallet is pretty great. I would say this is one of the best wallets I've actually used, just in terms of great dashboards at the top, wallet, history, staking, swap, governance, everything is right there, and it's just really intuitive. And being able to swap directly in the wallet is really nice. So here you can see the staking return right now is just under 6%, so not great. That being said, this has come down substantially just because the price of Luna has come up so much. I mean, heck, I think this was $13 or $14 yesterday. It was $5 just a couple weeks ago. So as that's gone up, because a lot of the returns are in UST or they're in other coins, the return has come down. And you can see that over here where it was looking at 11% and so on, 16% just in May. Additionally, you can see that there's these large jumps in yield. So each of these is a Genesis airdrop for one of the new projects that's launching on the Terra network. So the way this typically works is a project like Mirror or Pylon Protocol, when they first launch, they'll give a Genesis airdrop to all Luna stakers, and then they'll give weekly airdrops thereafter. So you can see that on days that this happens, it's 160%, 117%, 200%, and so on. So this is actually the strategy I'm using, and even though it's got a low APR right now, the reason is that there are 10 to 20 upcoming projects that have confirmed they'll be airdropping to Luna stakers. So we could be looking at a period where for weeks at a time, we're getting these crazy airdrops, and we're getting governance tokens for all these incredible protocols that are launching on Luna that even have the potential to appreciate and generate initial returns after the initial airdrop. And I want to make sure that I get those Genesis airdrops. So until those happen, at least until we get a few of the large projects that we're waiting on, I'm staking my Luna in here, earning my APR, waiting for the Genesis airdrops. And I think this is a bit more risky than the UST strategy, simply because you have your money in cryptocurrency, but is probably overall, at least from my view, the best risk-reward balance out of all the strategies we're going to talk about today. You get exposure to Luna, which is a phenomenal coin in a growing ecosystem. You get airdrops for new ecosystem projects, but you're not risking something like liquidation, like we'll talk about with some of the other strategies. So that's staking Luna. Strongly recommend it. The main risk you need to watch out for here is there is a 21-day unstaking period. So, for example, imagine you bought in at $5 a few weeks ago, and then you're up to 17, and you said, "Oh, I want to sell." You have to wait 3 weeks. So, could be that this will be much higher in 3 weeks. Could be that it'll have retraced, and so you do have to be careful about that. But if you're in it for the long term, like I am, then that's not a huge deal. All right, so let's hop back over to Anchor, and strategy number 3, if you recall, is to provide your Luna as collateral and borrow money against it. So looking over on the borrow section, first you'll have to bond your Luna as B Luna, maybe you call it Bluna, but B Luna, and then with B Luna you can borrow against it, and it varies based on a few factors, but when I tested it out for this video, I was able to borrow roughly 60% of the collateral value. So if you put in $1,000, you could expect to borrow about $600. And the crazy thing about this is that, so you're paying a 21.53% interest rate, but the insane part is that Anchor actually pays you in governance tokens in exchange for borrowing money from them. So they pay you 50.84% APR, giving you a net APR of over 29%. So that's actually positive interest that you're earning for borrowing money. It's actually higher than the interest that you would earn if you were depositing money with them. And I'm sure this is to incentivize people to borrow money off the platform. But you can think about this. So this is some additional APR in addition to the value of the money that you're actually borrowing, you're earning this additional 29%, and that's pretty awesome. And it's in a phenomenal governance token, Anchor, since this is such a good app. So you borrow your money on this, and then what you can do is you can hop on over to Pylon Protocol. So Pylon Protocol, their governance token is Mine, just launched a few weeks ago, currently right around 10 cents. And what Pylon Protocol does is it leverages those yields on Anchor and allows people to connect those yields to either projects that are launching, so it's sort of a launch pad, or it connects them to external services like, for example, a gym membership or Netflix or something like that. And you can keep your money deposited and then spend the yield on either monthly bills or on buying tokens from projects that are launching. So again, this could be a good use if you take some profits or you have money on the sidelines. Rather than just letting it sit around, you could put it on Pylon, use the yields to pay some of your bills while you're waiting to buy back in. So pretty cool project, and perhaps you think that has potential, and perhaps you like 161% APR, which is the APR on the Mine UST liquidity pool. Then you may want to take your money that we borrowed on Anchor, so the $600 from here, and then convert it into Mine and UST and put it in this liquidity pool for an additional 161% APR. So this is pretty great. I don't think this yield will last forever. I doubt it will last the full year, but we're going to look at some annual calculations. But make hay while the sun shines, so you can earn some pretty incredible yields while this lasts. So let's look over here again. So I did some calculations for this one. So imagine you started off with $1,000, borrowed 60%. This APR has come down since I first made this spreadsheet, so it's 29.3%. So you're borrowing, let's say, roughly $600. You put it into this pool, and you put this additional APR that you're earning back into this pool. If you're compounding that weekly in the Mine UST pool, you'd be looking at having roughly $4,500 at the end of the year, and that's not even considering appreciation in coin. So it doesn't consider the fact that Mine could go up, Luna could go up. So the implied APY on this, we're looking at 352% APY, and yeah, that's pretty solid. I think especially when you're getting access to high quality coins like Luna and Mine, then this is a pretty good APY. Usually when you see that, it's on some sort of Ponzi based project that doesn't actually have intrinsic value like these do. So this is the third strategy. The risk of this is, of course, that you be liquidated. And that's why I'm not doing this, because I think Luna is going to $50. I think Luna is going to $100. Luna is probably going beyond that. That being said, it is cryptocurrency, so we're going to see pullbacks along the way. We could easily go to $60, retrace to $30, and then push up to $100. And so when you see those sorts of pullbacks, if you're heavily leveraged, you get liquidated. And that's, by the way, the reason I didn't look at a strategy where you would invest all of these returns back into your starting deposit and borrow against them. And that's just because I think that's you're running a high risk of having bad things happen if you do that. If you lever up to the maximum amount over a long period of time, then eventually you'll get liquidated, and that's just not worth it. It's not worth the yield if you lose everything, and there's no coming back from that. If the value goes down, you can hold it, and if you're confident in the project, it will come back. If you get liquidated, then you're out of luck. Hope you had some UST saved up. Anyways, that is strategy number 3. So moving on to the fourth and final strategy. That is to take that same money borrowed on Anchor, so starting off the same, let's say it's $600, and bring it over to Mir. I'll claim that later. And on Mir, you can actually farm projects. So you can farm synthetic assets. Mir is similar to synthetics. And you have mirrored Twitter, mirrored Microsoft, mirrored Baba, mirrored AMC, and so on. United States Oil Fund. And you can see that these farm APRs are pretty incredible. Short farming is even better. I looked at long farming because I figured most people are probably going to tend to be bullish on technology if you're investing in cryptocurrency. That being said, you could even split it halfway between them, and then you're winning no matter what, whether it goes up or down. You're not going to get appreciation, but you're gonna get almost risk-free reward by farming both of these. And the way this works is it's basically a liquidity pool. So you can see on the long farm, if you did mirrored Microsoft, you provide 50% of the value in mirrored Microsoft, 50% of the value in mirrored UST, and then you'll get rewards from that. You can see there's AMC for all my AMC short squeeze people, GameStop, Tesla, Square. There's also some mirrored cryptocurrency assets, silver, and so on. There's quite a few on here, and they're adding more every week. So this is another good option. You can see a lot of these are around 30 to 40%. So for the calculation that I did, I just used 35%. And again, the real beauty of this is that not only are you gaining these yields, but you're also getting exposure to tech stocks. So this strategy is perfect if you want to keep your exposure to Luna and then you want to borrow against that and then get some exposure to some traditional equities. So let's jump back over to our spreadsheet, and we can see that using 31%, so very conservative, you would have an APY of about 114%, or using 30%, excuse me. If we went back up to 35%, then it would be about 119%. So still very solid, still very respectable, particularly when a lot of your exposure, about half your exposure in this strategy is to traditional equities that are much less likely to go down by 50%. I mean, anything can happen, but it's, to me, not very likely that the price of Apple or Amazon goes down by 50, 60%. If it is, then probably you have bigger problems, and probably these strategies are all going to be irrelevant if we see a crash of that magnitude. All right, so thank you again for watching this video. Hope that some of you found it useful. Let me know what you think down below. Are you going to use any of these strategies? Are there any other yield farming strategies that you're using on the Terra network? And do you think that Luna is still a good buy? It's come up quite a bit. Do you think that it's going much higher? And are you buying in? Thanks again, and until next time, this is Dynamo DeFi.